Decision this week to leave interest rates unchanged has led to a lot of questions about whether there will be a hike coming this spring. And what does that mean for you as a consumer? Joining me now to talk more about this is James Brewer. He's a nationally recognized certified financial planner, and he is the CEO of Envision Wealth Planning. James, good to see you. Thanks for being here.
I'm excited to be here.
Let's start here. Of course, we often hear this, our friends at NPR always tell us, Wall Street's not the economy and the economy's not Wall Street. It did, however, react to the potential for these rate hikes coming soon. What will it mean, though, for Main Street?
Well, I think first we should always just simply tap the brakes. I don't think that there's a lot to be too excited about. To understand why have rates been low in the first place, which was kind of a post-2008 situation. We remember things were in a shamble. People were saying their 401k was a 201k, and then we were trying to get the economy going. So rates went down, and they have been historically down for quite some time. With most things, we're trying to have something moderate. So with all the, hype to me, part of the issue was, why do we have this announcement anyway? And it was because they started seeing inflation, which had been historically low. It jumped past its historical average, was about 3%. And now they said it was headed on the 7% trajectory. So before, inflation, the rising prices of things got too far out of hand, they then signaled, hey, we're going to do something about this. So overall, that to me is a positive for, Main Street, the regular folks, that we're trying to keep things moderated.
I'm glad you brought up the 401k. What should people be thinking about now in anticipation of the rates rising as it relates to their 401k or plans to buy or sell a home?
Well, I think the first one is thinking about the home. On the home side, when prices go up, then that generally means that buyers may not want to pay as much money as they were paying before, because you do the math, increased rates times the same price means that they would have to pay more if indeed that was the case. So for new home buyers, they probably are going to want to get prices that maybe what they were paying over this last summer, they wouldn't want to be paying now. So it could switch from what was a seller's market to more of a buyer's market in terms of that. I think some people concerned about, well, but if the rates go up and I buy like the, $300,000 home, that's going to mean maybe paying $45,000 or so more in a 30-year mortgage. Well, hey, if rates go down somewhere over 30 years, you might be able to refinance. So maybe that's not too awful. Regarding the 401k, the stock market has this wonderful way of adjusting. If you are 20, 30 years from retirement, I don't think there's anything to really be worried about, because we're going to see ups and downs and blips. There was one that was this week, and there's going to be some all the time. If you're closer to retirement, then I think you should start to think, what should my post-retirement asset allocation, meaning, hey, what target rate of return should I be going after? Maybe you need to start thinking a bit more about that holistically, and not so much, well, what's the short term going to be? I hope you're not trying to make too much money, and you're going to take a more moderated approach, again, especially if you're close to retirement.
Some important advice. James Brewer, thank you.
You're welcome. Thanks for having me.